Good evening. This is Mark Teran, your mortgage man since 1986. And tonight we want to go over the CalHFA California Dream for All Shared Appreciation Program. But a couple of housekeeping items first. The links, I am going to be recording this and putting this onto my YouTube channel, which you can find on YouTube under @MarkTeran, Your Mortgage Man. And so all the links that I talk about tonight will be included on my YouTube channel. I'm also streaming this currently on my YouTube channel, but I'm not monitoring the chat over there. I'm on Zoom, and if you put a message in the chat there, then I will answer for you. Otherwise, please feel free to reach out to me by email or text if you're watching the recording replay of this. And if you'd like a copy of the PowerPoint, also you can reach out to me. My email is mark.teran@apmortgage.com. My text number is 916-768-6530. So let's jump into this program. First off, I'm showing you here the California Housing Finance Agency link, which will be available to you, and also the California Dream for All Shared Appreciation Loan Program handbook. That will be available as well. All right, let's see if this will do what I want it to do. Okay. So I'm finding, oh, there we go. My captions were interfering with my PowerPoint presentation here. And I got that moved away. So let's talk about what this program is. This program, for those who don't know, it came out last year in 2023, and it was a very popular program that sold out in about 11 days. And there was just a little bit of chaos around it. They've made some changes to it. And right now we have pretty much the outlines of the program, but there are some things that they're still going to be letting us know about. And so we will certainly address that as time goes on. And that has to do with the registration process. This program is for first-time buyers. It's a down payment and closing cost assistance of up to 20% of the sales price as a shared appreciation loan with a maximum amount of $150,000. The minimum combined loan to value is going to be 95%. So it's not like you can come in with 20% down and get an additional 20% and really get a low loan amount. They're going to minimum combined loan to value is going to be 95%. And there is a new income limit that must be less than or equal to their Dream for All income limits. And of course, that link will be there. In the areas that I primarily serve, I can help you out throughout California, but I am personally located in Sacramento County. So Sacramento County, Placer County, and El Dorado County, the income limit is $180,000 that you can't earn over to qualify for this program. So the payments on this are deferred for the life of the loan, and repayment of the principal and any shared appreciation are due at the time of these following events. So if you transfer title to the property, if you sell the property, if you pay off the first loan, or if you pay off the subordinate loan principal balance, or if you refinance the first loan, which would constitute paying it off. And I should mention that CalHFA does have a provision whereby they'll allow you a one-time refinance opportunity. And of course, resubordinating this shared appreciation loan. So that is possible, but it's one time only. And then of course, if for some reason we get into default and we have a notice of default and it doesn't get cured, then this is going to become due and payable. This is not an assumable loan. me check and see if we have any questions going on over there. I don't see any. So let's talk about the program appreciation share so we understand what that is. So for borrowers with incomes that are above 80% of the area median income, and that's determined by using the Fannie Mae Home Ready Lookup tool, and the link will be there in the comments section on my YouTube channel, then they will give up to 20% of the home price as down payment assistance, and the share of appreciation will be 20% of the home price. And it's basically 1-to-1, right? So if you're getting 20% assistance on the purchase price, you're going to pay back 20% in shared appreciation when the time comes due. For borrowers with income less than or equal to 80% of the area median income, using the same Fannie Mae Home Ready Lookup tool, then that shared appreciation loan, they still give you up to 20% of assistance of the sales price towards down payment or closing costs. But your share of appreciation that needs to be paid back is reduced to 15%. So using a factor, we're going to be saying it's 0.75 to 1 of the program appreciation share. In addition, they're going to cap that shared appreciation, and it's capped at 2.5 times the original principal amount. So let's go to example 1 and show you what that might look like. Let's say we've bought a house at $500,000. We've got our 20% shared appreciation loan, so it's $100,000. That's our original shared appreciation loan. 2.5% of that would be $250,000. And let's say you had this for 20 or 30 years and your property massively went up in value, right? There potentially could be a large amount due on that shared appreciation, but there's a cap. So you would pay back the original 100,000 and maximum of 250,000 in share appreciation. So you would max out at 350,000 in this example. Now, in most cases, I don't think you're even going to come close to that. The formula for determining the shared appreciation, we're going to go over that next. So you're going to take the current value of the home as determined by CalHFA and subtract the lesser of the original sales price or appraised value of the property is going to equal your net appreciation. So let's say in that example, you bought the home at 500,000 and you sold it at 700,000. So 700 minus 500,000, you've got 200,000 in your shared appreciation. Then you're going to multiply that shared appreciation percentage, right, based on what level of income you had, and that will equal the shared appreciation amount owed. And we're going to go over a couple examples. So in this first example, number 2 here, let's say your median income is above 80% of the area median income. And in the areas that I'm closest to, Sacramento, Placer, and El Dorado counties, that income at home ready income limit at 80% is $91,120. So we're saying if we earned over that amount, then let's say our original sales price was $500,000. 20% of the sales price was $100,000. So that's our original shared appreciation loan. And we're a few years off into the future. And at the time of selling the property or refinancing it, that new value is now $700,000. 700 minus 500 is 200,000. That's the appreciation that we had on the home. And we're going to multiply that by 20% and get $40,000. So the amount you're going to owe back to CalHFA will be your original shared appreciation loan of 100,000 plus your share or the program share of appreciation of 40,000. So in this case, you made $200,000 in appreciation. You're going to pay back 40,000 to CalHFA, and the other 160,000, because you chose home ownership, that remains with you in your pocket. So in this case, we would pay back the original loan of 100, their share, 20% of that appreciation, 40,000 bucks. So $140,000. Let's go on to the next example. In this case, we're talking about someone who is earning Placer, Sacramento, El Dorado. The number is 91,120. If they're earning that amount or less, then this is what's going to apply. In this example, we're going to say, hey, they bought the property for 400,000. They got 20% assistance. So they got an $80,000 shared appreciation loan. When they sold the property, they sold it for 600,000. So 600 minus 400 leaves 200,000 for the appreciation of the property. And 20% of that is 40,000, but we're going to multiply by the 0.75 factor because of the lower income limit here. And so that makes that 30,000. So what they're going to owe back to CalHFA is the original 80,000 plus their share of appreciation, which is 30,000. It's equivalent to 15%. So we pay back 110,000 to CalHFA for their assistance. However, we got to pocket the difference. So 200,000 less 30, we got $170,000 in appreciation that we got to put into our pocket. Folks, that is not shabby at all. Let me check and see if I got any questions going on. Looks like we're all good. Next slide. So obviously there's some qualifications to it. It is an owner-occupied only loan. All borrowers must occupy the property as their primary residence within 60 days of closing. Non-occupant co-borrowers are not allowed, and non-occupant co-signers are not allowed. Eligible property types: single-family, one-unit residence, yes. Accessory dwelling unit with guest houses, granny units, and in-law quarters are eligible within parameters. Condos and PUDs that are approvable by Fannie Mae, those are doable as well. Even manufactured homes that are permitted per Fannie Mae's guidelines, either using their advantage or standard, will work for this product. Other things to be aware of: at least one applicant must be a California resident, and at least one applicant must be a first-generation home buyer. So that's one applicant, not both, but one. And so here's the definition of a first-generation home buyer. That's a home buyer who has not been on title or held an ownership interest or have been named on a mortgage to a home, right? And that would mean a property that's on a permanent foundation and the land is owned underneath it in the US for the last 7 years. And to the best of that home buyer's knowledge, whose parents, whether they're biological or adoptive parents, do not have any present ownership interest in a home in the US, or if those parents are deceased, did not have any ownership interest at the time of death in a home in the US, or an individual who has at any time been placed in foster care or institutional care. Applicants must complete a pre-registration application through the Dream for All pre-registration portal. And they have not given us all of the terms regarding this just yet. That will come out a little bit later on, and we will hold a informational training on that as well. We do know that qualified applications will be randomly selected to receive a voucher once the pre-registration portal is closed. Next, you must be pre-approved through a CalHFA approved lender, of which of course I am. And that's really going to be your first step, is going to be getting pre-approved, because that happens first before you can go into registering through the Dream for All pre-registration portal. Details on the pre-registration portal will follow, and we're anticipating here probably within the next month or so would be my expectation. Now, the last time this program came out, there is a home buyer education course that must be taken, and there is a component to it that requires a counseling session. And the last year when this came out, a lot of us had difficulties getting our counseling sessions scheduled timely. So that's one of the second things that you probably want to knock off your list if you are interested in this product. You can take it online. It costs $99. That certificate is good for 1 year, and it also works for the other CalHFA products, because I'll remind you, not everybody is going to get this loan. Once you register through the portal, they're going to randomly select and give a voucher to those that win, kind of like a lottery system. And then they're going to have so many days, I think it's 90 that they're talking about, that you'll be able to go out and secure a property and then go through and finish off your process. So if for some reason this particular product does not work out for you, when you meet with your lender, whether it be me or someone else who's approved to handle the CalHFA products, there are other programs through CalHFA that you potentially can be qualified for, and they'll go over all the terms with you. So you're going to have options. And knowing that in advance, I just share it'd be a good idea to get pre-approved as quickly as possible, because it is likely going to be a popular program as well. And you want to get your education certificate out of the way so you're not stressing about trying to get your counseling certificate done. There's also a second course that is regarding the shared appreciation portion of this program, and the link will be in the comments section as well. And that course is fairly simple, really not that big a deal. It's this home buyer education course that I really recommend that you get out of the way if you're looking at following through on this program. This is a conventional based loan. It requires 0 down payment with a maximum of 95% combined loan to value. It does have a minimum credit score of 680. However, if you fall in that 80% of the area median income and less, Sacramento, Placer, El Dorado, that's $91,120 and less, then 660 would be the credit score minimum that would be needed. Your qualifying debt to income ratios, they're going to be a maximum of 50% with credit scores equal or greater than 700, and a maximum of 45% for those with credit scores less than 700 or purchasing a manufactured home. Now I'm going to bring up another slide here that goes over. See if I can bring it up for us. Here we go. And click on share. All right. So here I wanted to give you an idea of what the numbers look like, because getting the 20% assistance obviously is going to help you out with your payments. It also eliminates mortgage insurance. The interest rate is not published yet. I'm using a fairly standard rate for CalHFA today. I don't know if that's what it'll be, but it gives us an idea and a starting point. So the first column here, I'm showing you what it looks like at a $400,000 price. Your total monthly payment with principal and interest, property taxes, homeowners insurance, whole ball of wax is about $25.49 on a $400,000 purchase price. The cash needed, if you don't get any help towards closing costs from the seller or another type of closing cost assistance, you're about $15,400. In the second column here, 500,000, you can see your payments would be 3186 and cash to close about 18,150. 600,000, you're about 3824 on your payment and roughly $21,000 to get in. And at 700,000, you're about $4,461 a month and about, let's say, $24,000 to get in. And that is significantly reduced if you compare that to trying to purchase a home, let's say with 3 or 3.5% down. So this makes home ownership much more affordable starting out if you're able to get this program. And honestly, even though there is shared appreciation, if it is, one of the few ways that you can get into a home that's going to work for you, I would highly recommend it because homes are going to continue going up, right? There's not a housing crash going on. We have a housing shortage. I don't see that changing anytime in the near foreseeable future. So this is an excellent way to make it affordable for you and get you started. Let me go back and share my other screen. I think it's that one right there. Make sure we get the right screen up there for you all. All right. So we have gone over the basics of this program. See if we have any questions up there. I don't see any, but if you do, please feel free to reach out. I am Mark Teran, your mortgage man since 1986. You can reach me at mark.teran@apmortgage.com or on my cell phone, 916-768-6530. I have a special gift for you for having completed this educational video about the Shared Appreciation Program. If you send me an email with the words Dream for All credit within 48 hours of viewing this, and since I don't know when you might be viewing it, I'll say not later than May 1st of 2024, and you close your loan with me by the end of the year, I will give you a $695 off of your closing costs. This applies to new purchase loans and does not apply to any HELOCs or second loans. And if you would like a copy of this PowerPoint, please reach out to me at any of those ways, and I'd be more than happy to share it with you. If you've gotten value from this, please hit the like button and subscribe below.